Hey guys, it's Sunmin and welcome back to Your Money Game, the show where you learn how to think, spend, invest, and hopefully earn a little bit better with your money. So most of us work between 45 to 48 hours a week. That's a lot. And if you've ever tried investing, you know that it's difficult. So imagine with that busy work schedule, you want to put all that time, energy, and effort to thinking about and picking individual stocks, building that portfolio, and then eventually managing it as well. So unless you're super into it, that's a whole lot to do for an individual or regular person. But I found that there's a better way of doing it called index investing. So I'm going to teach you how, and let's get to it. So before I start, I've got to assume a couple of things. The first is that you know what an online broker is, or at least have the resourcefulness to get access to one that has access to the US stock market. The second is you understand what a stock symbol is. The reason is I'll be using a couple of these terms later and I don't want you to get lost. So let's start with why index investing. And one of the first reasons is the difference between active and managed investments. With index funds is what you call passive investing, where the fund is trying to mimic the performance of a stock index. And all the research has pointed to the majority of actively managed funds do not outperform the stock index. The second is individual investing is hard, not just from analyzing and picking those stocks, but having the emotional strength, the discipline to see it through over a long period. And research points to the fact that individual investors over a long term do not tend to perform well. Finally, research also points to the fact that low fees are one of the strongest indicators of long-term performance. Most actively managed funds tend to have fees between 1% upwards to even 5%. And with a lot of these index funds which I'll show you, they'll start at anywhere between 0.03 up towards 0.09%. So that's a huge difference. Now there are a few things to understand before we actually start this strategy. The first is that it's a long-term one. So if you're hoping for this to yield you strong returns in 3 to 5 years, this is not the right strategy. The next point to understand is that while they talk about returns being, for example, 8 to 10% over a long term, it does not mean that every year it's consistently 8 to 10%. It means that some years you might be 0 or even negative, but some other years it'll be an outperformance or maybe like 20-30%. But net over the long term, it averages to about 8 to 10%. The other good thing about this strategy is that it's very easy to start, but it's also easy to scale up. The moment you become comfortable, you can learn more and then you can adapt that strategy to make it fit your individual style. Let's start from ground zero, which is how much money should you allocate to this strategy? Say you earn $5,000. Out of that $5,000, you need $3,000 to take care of all your bills, take care of all your necessities. And with the $2,000 that's left, say you're planning for an expenditure that's coming up in the next few years, and you need $1,000 for that. And so you park that aside, you put it in a high yield savings account. You've got that final $1,000 that you think to yourself, look, I'm putting this away for my retirement and I can afford to invest in the long term. That $1,000 is what you take to put into this strategy. Next is the question of how do you divide that money? So with that $1,000, how do you divide it into the different things that you need to buy? Now this is an area called asset allocation, and I did a whole video about it before, so you can check it out if you want to learn a little bit more in detail. To summarize it, it's really about the ratio of how much money would you divide to put to risky assets, which are stocks, and safe assets, usually are bonds. There's a simple rule of thumb that people use to start thinking about this ratio, and it's 110 minus your age. So say for example, you are 30 years old. 110 minus 30, you're left with 80. So if you had $1,000, 800 would go to buying stocks, 200 would go to buying something like bonds. Ultimately, it's a very personal choice. But from all I've seen in the research, it points to the fact that most of us here in Singapore, and I'm very sure in Malaysia as well, we are very risk averse. And we tend to be underexposed to stocks, which means that the returns that we're getting from these type of savings accounts or fixed deposits, it's not going to help us deal with inflation in the long term. Another personal choice is for you to hit that like, subscribe and bell button as well, because that really helps my channel out. So let's get to the meat of it. What do I buy? There are 3 simple options that I want to share with you. The first is SPY, which is the Spider S&P 500 ETF. And it's the most liquid ETF that you can buy, and annual costs are somewhere between 0.09%. And right now in the market, it's about 290 plus US dollars per share. The second option is called VTI by Vanguard, and specifically VTI is an exchange traded fund that tracks the entire US stock market. So previously with SPY, it only tracks the S&P 500, which are 500 of the largest US companies. Right now, you can buy it at $146 per share. One more option you can consider is SCHB by Schwab. And Schwab is another really large financial institution with a strong reputation, so you can be assured that it's a solid fund and it's not going to disappear overnight. Like the VTI, SCHB tracks the total US stock market and it costs you much less. And currently it's about 69 over US dollars per share. As you can see, those three options, SPY, VTI and SCHB, all track roughly the same thing. And again, they're not exactly the same, but what you want to notice is the different price points. The reason why that's really good for us as individual investors is that with the lower cost, even though it tracks the same thing, it allows us to access the market at a cheaper rate. For those of us in Singapore, we can actually buy the S&P 500 ETF right on the SGX. But the problem is, if you're buying it through the stock exchange in Singapore, you have to buy a minimum of 10 lots. So what that means is that at one transaction, you'll have to fork out roughly 2,800 or 2,900 US dollars in one go. Now that we've taken care of stocks, the next thing to think about is bonds. What do you buy? To make this really easy, just buy BND, which is a Vanguard fund that tracks the total bond market in the US. Because this should be a relatively small portion of your portfolio, you shouldn't need to worry too much about the different type of bond funds out there. And they are quite a lot. And with that said, if you bought these two funds, congratulations, the foundations of your portfolio are built. So now that you've got your two funds as a base, let's talk about growing from here. The first thing to do is to think about consistency. Right now, the most important thing that you can do is to think about taking that monthly income, setting up a routine to transfer some of that money to your broker, and then consistently buying and investing in those funds. The next thing is that with those two funds as your baseline, you can begin to think about diversity. So me, for example, I've purchased a fund that has access to the emerging markets, and the reason why people diversify is to reduce the risk overall and hopefully enhance their returns as well. The last thing to do is actually maintenance, and it's simply rebalancing your portfolio on an annual basis. So for example, with the two funds that you have, stocks and bonds, what you need to do is relook at the total value, buy and sell either of each to get it back to the original ratio that you were comfortable with. Now that we've gotten the strategy out of the way, there's still a few things that you need to be aware of. The first thing is cost. Now if you looked at the three options which I recommended you, you would not go wrong. But if you're doing individual research and you're digging out there, you might come across funds that talk about themselves as index funds or passive funds, but not all of their costs are equally low. So always be alert to this term called expense ratio. Next is currency risk. This strategy requires you to hold quite a lot of US dollars. Now if you're confident in the US dollar in the long term, confident in the US economy, this might not be a huge deal. You should be aware of it nevertheless. The last thing you need to be aware of is taxation. Capital gains are not taxed. However, dividends are taxed. So it's a flat rate of 30%, which is quite high. And the US government withholds it automatically, so you don't really need to do any tax filing, but it is tax you pay nevertheless. So if you wanted to buy the SPY but not be hit with the 30% withholding tax, there is another option for you to try and look into, and it's what you call a UCITS. And it's an Irish domicile ETF where the taxation rate is only 15%. But you'll have to have access to other stock exchanges to buy it, for example like London or Germany's. So that's it. I hope you got a great overview of the strategy and you feel confident in taking charge of your own money, allocating it towards these funds, buying those two things, using that as a base to grow. So I hope you found all the information valuable, and if you did, I really would appreciate that like, subscribe and hit that bell button as well, and I'll be back again next Sunday with a brand new video. So until then, take care and keep playing your own game.